Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and I'm speaking today with Jordan Roy-Byrne, founder and editor of The Daily Gold. We will put a link to The Daily Gold down below this editorial so you can follow along with Jordan's work. Jordan, it's great to get you on the call here just to talk about the markets. Let's start off with a technical take on things. When we look at gold big picture, it's holding up pretty well. It's not doing anything to really break out or break down, but over the last couple of weeks after getting down to that low in the 1820s in October, it has had a couple week rally. It's been held up by interest rates pulling back some, the dollar pulling back some. In reality, everything has rallied, even the general markets have over the last couple of weeks. But just from a technical standpoint, do you like what you see here in gold as far as it having bottomed in October? Does it have any legs to keep running? Are we getting near a stall point of resistance? How are you looking at gold technically?
Yeah, I mean, very big picture, gold, it's holding up really well. I don't know if that precludes it from trading lower and testing 1910. There's significant support around that area. In addition to that, you have significant support at 1850. So when we're zooming out from the short term, those are the levels, the support levels to look at. If you tell me it's going to hold 1910, 1915, that area, then that's a very good sign that it's probably headed for a breakout move at some point over the coming months. Now, however, one thing that concerns me a little bit is looking at gold against the stock market, gold against the S&P, trading at 0.44, at least coming into today. It's been in a range over the last 2 years from about 0.50 to 0.42. So I don't want to see that ratio break down here below 0.42. Again, it's trading around 0.44. So if we were to see gold against the stock market break lower, that would indicate that maybe there's another round of more money moving into the stock market and some money selling gold. So that would be a bad sign in the short term. In that scenario, I would think that gold is at risk for breaking below 1910 and 1915. But I'm just thinking ahead of where we are here in the short term. But moving from the short to medium term, that's really my concern. So we'll see how that plays out with respect to gold against the stock market. And that to me is going to inform us as to whether this correction morphs into something that's bigger or not.
Yeah, I mean, I have the same concern, Jordan. I was going to ask you about this move that we've seen in gold. It's happened in tandem with an even bigger move in the stock market. When you look at the small cap stocks in the Russell 2000, they've taken off like a scalded cat over the last couple of weeks, especially the last couple of days. And really, most of the S&P and Nasdaq stocks are up. Even market breadth is improving in the general equity market. So isn't that just stealing the thunder or the reasons why people would want to be positioned in precious metals, but in particular the precious metal stocks?
Exactly. And again, zooming out and looking at the big picture, we've been in a secular bull market in the stock market since 2009, and especially in the last 4 or 5, 6 years. Although gold has performed well and it's had higher lows until the last 3 years, the stock market over the last 5, 6, 7 years, every time it's pulled back, it's made a higher high, even after COVID, whereas gold has not. Gold's been stuck for 3+ years now, unable to break above 2050 to 2100, that resistance area. So in order for gold to break out, we're going to need to see money and capital flee the stock market and come out of the stock market. Now, we've seen a lot of money flee the bond market, and that has helped gold to a degree. That's probably a big reason why gold has been holding up really, really well, and why it hasn't traded down to, 1700 again. But I mean, I don't mean to make it too simple, but any strength in the stock market, a continued rebound, if the S&P were to make new highs, that means there's more money going into the stock market. That's money that can't buy gold. And so there's going to be less additional demand for gold in terms of buying at that point. I'm not talking about physical demand. So that's just the reality for gold. I mean, it's play the Curb Your Enthusiasm music, because this is, every quarter or every 6 months, this has been a recurring issue, and it's going to continue until the stock market cracks and the secular bull ends. And I mean, look, when it does, it'll be glorious for gold. But again, we're not quite there yet. I think we're getting much closer, though.
Well, I want to follow up on this because when I talk to other people on the show, we have all these range of thinkers on, Jordan, and everybody's entitled to have different beliefs. But I'll often ask them, do we need to see a correction in the general equities to really get some traction in the precious metals markets? And many times people say, no, we don't necessarily need to see that. We know people think that, but no, they can go up together. You've done a lot of research on this, though, Jordan. You've looked at other historical periods where it's taken a rollover in the general markets to get some traction in the equities. It makes sense. You'd have to have money fleeing the stock market to go into the precious metals. To a degree, as you mentioned, some of the money fleeing the bond market probably did help. I guess money fleeing the bonds and the equities would be a double whammy. But could you provide some context for people that kind of shoot this idea down and say, no, if you want to see gold equities run and gold run, it can happen in tandem with the rising stock market. Explain to people where the research you've done into this, that's not necessarily the case historically.
Well, I mean, one thing I will say is that the only time where you had all markets really moving up together was the mid 1960s. And you could say that gold stocks were a proxy for gold because the price was fixed at that point. Gold stocks had this spectacular breakout in 1964. The S&P, the secular bull market, ended in 1968. However, from 1962 to 1968, the gains were really not that great in the S&P, even though it trudged higher during those years. Gold stocks really were the best performer. I think energy stocks also did really well. So again, this is the only example you can use to kind of disagree with my premise. And I think at that point in time, you didn't have all these alternatives. Like the bond market wasn't as big. You didn't have tips. You didn't have ETFs. There wasn't Forex, foreign currencies. Like basically your alternatives to investing in the stock market and government bonds. I mean, if you're a little bit worried about things, gold stocks, like that was the whole thing. So I think that is a big reason why they did really well at that point in time, while the stock market was still in a secular bull. Now it's completely different. And again, I just think people really need to study the big picture and look at how markets have moved for hundreds of years, or at least 100+ years. The best performance in gold, let's take it back. Gold, it was fixed in price, but when they let it go in 1971, it had this great move for 9, 10 years, straight up, basically. I mean, there's one correction in there. Straight up, what happened during that period with the stock market? It was in a secular bear. It was in a secular bear that started at the end of 68, lasted until 82. What happened after that? You had this spectacular bull market in bonds and stocks. Gold crashed and then went sideways to lower for 15 to 20 years. So it was in a secular bear. What happened after that? Secular bull in gold, secular bear in the stock market from 2000 to 2009, although some people say it was 2000 to 2011. Oh, look, it matched up perfectly with gold's secular bull. So now what has happened this time around, where the stock market has still made higher high. Every time it's pulled back, it's made higher highs. What's happened with gold? Gold's been stuck for 3 years. And gold, it peaked almost 13 years ago at 1900. Where's it trading at now? Let me look. 1965. So it's been at the same level as it was 12 to 13 years ago. And look at silver. I mean, look at the chart of silver since 2011. I mean, look at the chart of GDX, or the Huey Gold Bugs Index. Yeah, I mean, there's been some years they had a good move from 2016, and then from August 2018 to 2020, when you had the COVID crash in the middle of the thing. This has been a secular bear market for precious metals. In X gold, it's been really obvious. But gold, the way gold has held up in the last 12 or 13 years during the secular bear, and I've made the point, it is kind of similar to how the S&P performed from 69 to 82. So you're not going to see a big, powerful secular move in precious metals until you get the stock market to crack and it loses its 40-month moving average. Because you need that to happen for all this money to move out of that asset class and come into precious metals. And the one point I'll make in addition to that, if you look at cyclically, so there are cyclical points when you've had these great moves in gold stocks, and silver as well, and also gold. But if you look at the early to mid 2000s, if you look at, I want to say the early 1970s, the early, the 1930s, after 1931, 32, there are cyclical periods when the two go up together, when precious metals perform really well, in a cyclical period inside of a secular bull. And during those periods, the stock market can also perform well for a few years. But that doesn't change the overarching fact and nature of these secular trends. And so how could that play itself out in the coming years? Well, you get a bear market in the stock market, you get a recession, you get this huge breakout in gold, precious metals go into a secular bull, and that cyclical move will continue for a little while longer, probably during or while the stock market, has its recovery for a year or two and we get the next expansion. So there are points when they move together cyclically, but it's very important to understand the nature of these secular trends. So I don't know how people can think that. Like, they're just not working with all the information in the history, in my opinion.
Well, Jordan, I really appreciate you breaking that down. That was fantastic, because I think what happens is people look at a few of those cyclical periods and say, oh, look, stocks and gold all moved up together, but they're not looking at the larger secular trends. They're really not going far enough back in history and looking at overarching trends that we see over many years or sometimes even decades. And so I really appreciate you breaking down the difference between the cyclical patterns within the secular patterns, and that in general, you need to see money leaving one asset class and entering the other to get the big runs that you want to see in precious metals that are sustainable moves. That's more the macro side. Diving down into the micro side, let's look at the precious metal stocks and equities. No doubt that they're beat up. They've been beat up for a while. To your point, we've been in a secular bear, but some of the valuations in these mining stocks are really getting wacky. And you were mentioning just off mic that you've been looking at some companies and just analyzing it. How are you viewing the valuation in the mining stocks right now, Jordan?
Yeah, one quick thing I want to touch on, and then I'll get to that. A signal for a new secular bull market is gold breaking above 2100, which, yes, it's trading above the 1920 peak in 2011, but it hasn't broken out or pulled away from that level. I mean, at least not significantly so. And so this ties into what you asked me, because that gold breaking above 2100, that's the signal. All right, not only are we in a new cyclical bull, but we're in a new secular bull. So that's the important signal. That's what's going to drive everything for larger producers, mid-tier, intermediate producers, and also the juniors. And, with respect to the juniors, basically every weekend I do a significant update, and I have a table of my top 10 list and a watch list, and I always update what's their market cap, what's their cash position. And after last week, there were just several companies where I was looking at the numbers and I was just thinking, geez, this is getting really cheap. Like, this is reminding me of the low in 2016, the low in October 2008. So I'm not saying it's true for every company, but, and I don't like to give individual names because that's what people pay for. But whether it be some producers, some developers, even some optionality plays, like, the valuations on some of these stocks are like they're getting down to those really, really extreme levels. And so to me, that's also a good sign that we're approaching a major secular turn. I know there's something else we're going to talk about with respect to forced selling. So even though the technicals look ugly and money is of course moving back into the stock market has a chance to retest, maybe make a new high. We're not in recession yet. Yes, those things are putting pressure on gold and precious metals. But looking at some of these other things like valuations, that leads me to think that we are moving closer to that major turn. But it was more stark to me compared to like a couple months ago in the recent bottoms we have. Just the valuations that some of these companies are trading at. And part of the reason, and this is not the entire reason, but part of the reason, and I'm sorry, I'm probably answering your next question, is forced selling and redemptions.
Well, yeah, let's talk about it, because before this call, we were discussing that, a lot of people like to point to there's always some exogenous force. There's some nefarious actor out there suppressing the price of metals or the mining stocks. And I don't personally really fall for a lot of that, but there's no doubt that there are large funds that enter positions, and that can really be a boon to equities, or there's large funds that can exit. And it's the same thing even when you see ETFs. A company that gets included can have a big upswing on that purchasing, but if a company gets kicked out of the index. They can also have a big outswing. There are some big funds that have been changing their allocations to precious metals, and you've made note of that, and it is affecting companies. So maybe just speak to how fund redemptions can play a positive and negative role in these mining stocks.
Yeah, a little birdie told me, or at least I heard from a little birdie, that there's a significant size fund that has had a significant amount of redemptions, and that's been causing a lot of the selling and just the ugliness in some of these charts. And unfortunately, that can happen when you're in a rough market and you're in a bear market. These funds, they invested in juniors, and they can come in and sell at any time. And it isn't like they're selling Walmart or Microsoft where something gets sold and then boop, 5 seconds later, new money comes in, and it's like it never happened. I mean, this is different. This is a venture sector. This is speculation. And so you get a big holder who's dumping, not just dumping once, but they're dumping over a period of months. That can affect, well, obviously it does affect the chart on the stock that they're selling, and it can just be weak for a while, until everything turns. So I'm seeing that with more than a few stocks that are on my list where the chart looks pretty ugly. I mean, there's nothing, other than the gold price at 1900 and costs have gone up so much. But aside from that, there's nothing wrong with these companies in a vacuum where you're just looking at it by itself. But what you do see, and again, I track this every week. What's the market cap? How much cash do they have? How much debt do they have? And I'm starting to notice that just some of the numbers are getting out of whack. Like they're just getting too low on some of these companies.
One more follow-up on this then, Jordan. I wasn't going to ask you a question. I was just going to wrap it up here. But it makes me think of, I see comments all the time on chat boards, on a number of different platforms where people say technical analysis doesn't work in junior mining stocks because the moves can be so exaggerated on the volume. Like in this kind of a situation, if a fund is liquidating, it's going to create a lot of chart damage, but maybe nothing fundamentally has changed with the company. But I would argue that the price action is recording all of the action. And if a fund is liquidating, that is part of the fundamental picture. How would you address that comment that technical analysis doesn't really work for mining stocks? It doesn't matter if you look at the charts because the moves can be so exaggerated. How do you view it?
Well, it works if you keep it simple. And I always say when it doesn't work for me, it's because I made a mistake or I misinterpreted it. And so the problem with technical analysis and charting these juniors is, we all have biases. And so that's an issue. When you're in a bear market, like bullish patterns tend to fail. And so presuming that we're going to go into a bull market at some point in the first half of next year, I mean, you're going to see a lot of these ugly charts just turn around because that's what happens after bottoms. So you have to, Rick Rule always says you have to be a contrarian or you're a victim. And I think now and over the coming months, even though these technicals look really, really ugly, at some point they turn bullish because they can get really oversold. They can get down to significant support levels. So it just comes back to being able to interpret things properly. And, that takes years and years of experience, honestly. So it's a difficult game, and, things will be easier when we get into a real new bull market, a new secular bull market. That will make things easier. But the market that we've been in the last 5 or 6 years, it's been really tough to chart a lot of these stocks, because you've had some great rebounds in the sector. It appears we've been close to having to break out in gold, but it's failed every time. And it's very difficult. I can't simplify it down to 1 or 2 points, but that's the reality. Is you have to keep things, when you're charting these things, you have to keep it as simple as possible. Just look at the price, maybe 1 or 2 moving averages, look at the gold price and try and make an educated guess. And yeah, the charts right now, they're not good. I mean, they look pretty ugly. However, at some point that turns into the best buying opportunities. Think about how the charts looked in December 2015 or September 2008. When the charts look their ugliest, those can actually be the best times to buy. And so we'll see. If you tell me gold's going to break out in 2 or 3 months, then we're moving fast towards a really, really significant bottom. And so the charts on a lot of these stocks, they're going to look pretty ugly at that point. But again, more often than not, those are the times when you actually want to buy.
Well, we'll wrap it up there, Jordan. As they say, it's often darkest before the dawn, and some of these charts are going to be a mess before they take off. But when they take off, it'll catch many people by surprise. And I appreciate you just giving the advice to people to keep it simple. Often simplicity outperforms complexity. And I'll have you keep us posted on when we need to change our theme music from Curb Your Enthusiasm to Cool and the Gang Celebration. I think it's going to be after gold breaks out above 2100. But until then, Jordan, always great getting your thoughts. If people like getting Jordan's thoughts, definitely check out his work over at the Daily Gold. We'll put a link to that down below. And until our next conversation, Jordan, thanks for coming on the KE Report.
My pleasure.